If you don't know me, my name is Taylor Demaris, Certified Financial Planner at Demaris Financial Group. And in today's video, I want to explain what not only the problem is that many retirees can encounter with long-term care insurance premium changes, but what are the four options that they have. So I'll call her Janice, came in today, and she said that she got this letter that said, sorry, not sorry, we're here to increase your premiums or change the benefits to your plan, and not in a good way. First of all, how can they actually do that, right? How can they come back to their people that they signed a contract with and change it? Well, reality is when long-term care insurance first became new and really popular even a few decades ago, these insurance companies underestimated two key things. One, they underestimated how long people would actually live. And two, they underestimated how much healthcare expenses would increase to. Which fast forward leads us to today to say, okay, now they underestimated those costs, and in order to not become insolvent, they have to approach the Attorney General of each state, get permission to increase those premiums or amend the plan. So she comes to me and says, I got this letter. The third time she's got this come to her in the past 20 years, she's had this policy. And it's not uncommon. I see that all the time with my clients, and they say, what do we do? And Genworth is one of the largest companies out there offering long-term care insurance. So I have the conversation all the time, but across the different providers that my clients have insurance policies through, I see that it really boils down to four key options that they have as far as we're trying to pick the least worst option. Pick your poison, to put it more bluntly. And obviously I didn't have control over this. They didn't have control over this. So we need to just do the best what options we have. So the four options boil down to obviously changes in the policy plan. And the first of which is that the insurance company is saying, we need to increase your premiums just so you can keep the same benefits. Oh, that's no fun. Not. In fact, with my client's permission, I have the letter she brought in today. It was from Jackson, the National Life Insurance Company in particular, redacted their information on the, but it said that the percentage increase in premium was 28%. Now you can't see this really well, but 28% just to keep the same benefits that she agreed to the last time they changed her policy benefits. Ouch. Okay. Option number two is to say, well, if you don't want to increase your premiums, you can pay the same premium, but we're going to lower your benefits. Again, sorry, not sorry. So whereas she was originally going to have a maximum lifetime benefit in this case of around $255,000, that benefit would be reduced from 3 years to 2, and now getting a total of about $169,000. Ouch. So about a $70,000 to $80,000 drop in policy benefits just to keep the same premium. Okay, I don't like that option so much either. So what else do I have? Well, again, this changes for every company, but a third option that usually comes up is to say, well, we're going to offer you, term is called increased contingent non-forfeiture. What does that mean? It frankly just means we're going to allow you to stop paying premiums. You'll still get a policy, but it's capped at however much you've paid into it now. And again, different companies have different amounts that they calculate that to. Maybe they'll say, hey, you paid $50,000 into this policy. Your benefit is now $50,000 if you initiate long-term care benefits at some point in the future. $50,000, that's not a lot. No, it isn't. But that's all you're going to get for continuing to keep the policy at no longer paying premiums going forward. Okay, this doesn't sound like it's getting any better. What's the fourth option? Well, the fourth option is to say, all right, you paid so much into the policy. Now we're going to allow you to get a one-time cash payment returned back to you. So that usually looks like saying, hey, again, you paid, say, let's call $50,000 into the policy. We're going to write you a one-time check. That's going to go back to you, and it's a return of premium. Best case scenario. Unfortunately, in my client scenario today, they had paid about $45,000 in premiums across the lifetime of the policy, and the benefit that they were offered was instead $34,500. I know, really stinks, but that's what we had to choose from. And by the way, the option number 3 allowed her policy benefits to be capped at 150% of what she paid into the policy. So by the numbers, it said, hey, you paid about $45,000, you get a policy of $67,000-ish. But again, that money is only worth something to you if you actually make a claim and initiate the policy benefits. And the reality is no one goes into getting an insurance policy hoping to be able to make a claim on it, right? Think about it. How many times are you saying, oh, I hope I get to use my car insurance this month. I know I paid the premium, so I hope I get in an accident, so I can, cash in some of those benefits. Same thing with home insurance or life insurance, heaven forbid. You don't get an insurance policy in order to make a return on it, but you get it to mitigate risk. So fast forwarding to my client scenario, she already came in today's conversation knowing what she wanted to do. She wanted that cash. She was fed up with the changes and the whipsawing around from the insurance company and said, that's enough. I'd like to get my money back. And I ran through the options and thought out loud with her to say, hey, is this the best option for you? Turns out we felt that it was a good alternative for her because of a few things, but I'll get to that in a minute. So she was going to take cash out this policy and it was not going to become taxable to her. Remember, she paid in about $45,000. She's getting back about $35,000. So that's not any sort of gain. It's just a return of her money back. And so we had to sign the form. We got it notarized in our office for her and in fact out to the company as well. And that closed Janice's case today, right? What I want to expound and zoom out on is to say, okay, for other people out there that come across this not totally unique situation, how do you weigh those decisions? How do you know what to decide on? Fortunately, I'm able to help my clients walk through that, but for you, I want to highlight a few of the pros and cons. First of all, the obvious question is, once you get this letter, is to ask, do I still need long-term care insurance? And the reality is you don't know, of course. If we had that crystal ball working for us, and we'd have a lot of answers and all be living on our own private island. But there are a few factors you can account for to say, do I need long-term care insurance? Chances are that you have a better grasp on where your health is today than when you got the policy out. Again, my client was 20 years younger when she initiated the policy. Here she is today. She has a better idea of, okay, how's my health? How's my level of independence? And what have I seen from my parents or other people with my genetic strain? So in my client's case, she felt pretty confident about her health and being able to age out in her own home. There are other factors that clients can use to forecast whether they need long-term care insurance, such as what's the family support look like, right? My client's case today, Janet has her daughter that lives in her home with her already and has already volunteered to say, hey, if you need something, I will be here to take care of you full time. We'll see if that really happens when push comes to shove, but there's definitely among her and her other children some family support willing to help take care of her from a physical as well as financial standpoint. So that's key, but not all clients have that. So the next thing is to say, okay, if I don't have long-term care insurance, can I self-insure? And that's what most of my clients end up doing. Either they cash in their policy if it doesn't make sense, or they just never got long-term care insurance in the first place. What is self-insurance? It's just paying out of pocket for those costs, which can, yes, get very expensive very quickly. So you've got to really make sure you calculate and project out worst case scenarios in order to forecast, can I make it through a potential scenario where I'm paying 5 figures a month in care? Because that can happen really quickly. Reality is once one moves into an assisted care facility, whether it just be any level of care, it could be a independent living community or assisted living, memory care, etc., they tend not to move back into their original primary residence. Just the facts. The average lifespan for a male going into an assisted living facility is between 2 and 4 years. Women, a little longer, 3 to 5 years. And of course, there are outliers on both ends of the spectrum. So you want to try and make sure that, hey, if I'm going to self-insure, can I cover those costs? And I can put a link in the description to Genworth that has a cost estimator of what long-term care services are in your local geographic area, because it can vary on what level of care you need and again the certain region you're in. But as far as actually affording those costs, your home is probably going to be the bulk of taking care of those costs. One, because it's many people's single largest asset, and two, it is no longer going to be needed. I want to pass it on to my kids. It's sentimental to me. Yes, but what do you care more about, passing that down to your kids or becoming impoverished and living in with them or going on medicated? A scenario that I really don't think anyone wants to consider. So your home is going to be your primary line of defense for self-insurance, and then your other asset. Again, many times your investments. So how liquid are your investments? Are you in an annuity that has a fixed income, whether you like it or not? Or do you have options within a certain account, like an IRA, a Roth IRA, a brokerage account, HSA? Those are the different levers, as I like to call them, we can pull for clients to help them determine, okay, what income sources make sense. Not only from a need standpoint, but my goodness, from a taxation standpoint, which is probably a whole nother subject for another day, is talk about the taxation of pulling out from accounts, especially in particular for long-term care needs, which you can get really creative with, because if it's over 7.5% of your AGI, those medical expenses can be itemized and deducted, which again can get really high if you're in assisted living. Again, another subject for another day. But as far as this letter goes, navigating these decisions comes down to a lot of personal factors. I wouldn't suggest taking this video as specific advice to your situation, nor many other resources you find online, because the reality is, I don't know you. A lot of people online don't know you. And in order to take advice from strangers that don't know your goals or nuances of your situation is pretty hard to pinpoint. But those are some gauges to go off of. Do I need long-term care insurance? If no, then let it go. If yes, decide, is it going to hurt my monthly finances if I continue to bite the bullet and pay the increased premium, or just continue to pay it at all? And that's, again, another part of the conversation I wait with clients to say, maybe it doesn't make a difference in our finances. It's kind of a luxury, a discretionary expense that we have, is to keep this policy. And therefore, we're going to say, oh, this hurts, but we're going to keep paying it because it's going to potentially save us a lot of money and preserve a lot of our estate, so we don't have to sell our home, don't have to sell off our investments just to maintain our dignity and go into a certain assisted living facility on our own terms. That's what it boils down to for me. Is it going to hurt your finances in a way that prevents you from doing the things you need and want? If the answer is no, then there's a good case to keeping it. If you don't feel you need the insurance at all, make sure you're covered in other means by way of self-insurance, family support, and other means as far as either aging out in home or going to a professional assisted facility. I hope this helps. Give some feedback and some food for thought as you encounter a situation that most people hope they never have to come across, but unfortunately is more and more likely with those that actually hold a current long-term care insurance policy. If you found this video helpful or interesting in any way, please feel free to subscribe, like the video, tells YouTube that you liked it, and I've got some other great content and videos coming your way that you can be sure to be notified of once I release them. Thank you. Take care.